Welcome back to another episode. In this video, we will go through our Heiken Ashi trading strategy, including how we can effectively combine it with price action. Heiken Ashi candlesticks are excellent because they smoothen price movement. Heiken Ashi charting eliminates a lot of the noise seen in conventional Japanese candlesticks, which makes deciding when to enter and leave a trade a lot easier. This strategy is extremely effective for successful trading, and I'm sure you will greatly increase your earnings with this strategy. For this video, I have done a lot of research and boiled it down in order for you to easily understand it. Therefore, as the great trader that you aspire to be, you definitely need to watch through the whole video. If you skip parts of it, you will miss important information. So, bear with me. To begin with, I will explain the theory behind Heiken Ashi, and once you've understood the concept, I will showcase some very good practical examples in order for you to understand the strength of this trading technique. Eventually, I'm sure you will be able to use this awesome strategy for yourself and make good money. Here is some very important information I need you to know before we start. Everything we talk about in this video can be applied to both currency, stock, and cryptocurrency trading because price action is pretty consistent across different trading assets. Therefore, we are going very in-depth in this video. You can use this for any type of trading. Do you struggle with indecision about when to enter a trade? With the vast number of candlestick patterns available, it can be overwhelming to decide which one is the right signal to enter a trade. Have you ever experienced getting out of a trade prematurely, only to watch it continue in your desired direction? It can be frustrating to miss out on potential gains by exiting a trade too early. Trading can be a complex process with many factors to consider. If you spend too much time analyzing your entry rules, you may miss valuable trading opportunities. Similarly, exiting a trade too early can negatively impact your overall profitability. One solution to simplify the process is to use Heiken Ashi bars to make precise decisions about when to enter and exit trades without the need for complicated analysis. In this video, I will present a strategy using the Heiken Ashi technique to simplify the process of determining when to enter or exit a trade. But before I do, let me explain what the Heiken Ashi technique is. The Heiken Ashi technique is a Japanese candlestick-based technical trading tool that uses candlestick charts to represent and visualize market price data. It is designed to identify market trend signals and forecast price movements. The Heiken Ashi method uses average price data to filter out market noise, which results in a clear illustration of market trends and direction. This helps traders determine potential price movements and assists them in identifying when they should hold onto a trade, pause a trade, or identify if a reversal is about to occur. The Heiken Ashi trading technique was developed by Munehisa Hama in the 1700s. The technique shares certain characteristics with traditional candlestick charts that are commonly used in trading. However, it differs in the way that values for the candlesticks are computed. In Japan, the word heikin translates to average or balance, and the word ashi means bar or foot. As a result, the name Heiken Ashi literally means average bar, which aligns with the trading technique as it uses the average price of the security. When comparing Heiken Ashi to traditional candlesticks, the main distinction is that the former uses a modified formula based on two-period moving averages instead of open high, low, and close prices. This results in a smoother chart which makes it easier to identify trends and reversals. Additionally, Heiken Ashi charts also tend to obscure gaps in some price data. The left chart in this example is using traditional candlestick bars, while the right chart is using Heiken Ashi bars. It is clear that the Heiken Ashi bars provide a smoother visual representation. This is why some traders prefer to use Heiken Ashi candles, as it reduces noise on the chart and allows for a clearer analysis of trends. Heiken Ashi charts differ from traditional Japanese candlestick charts in the way that prices are displayed in terms of the open and close. When observing a Heiken Ashi chart closely, one will notice that every Heiken Ashi candlestick starts from the middle of the preceding candlestick rather than from the level where the previous candlestick had closed. This is a result of the unique calculation method employed for Heiken Ashi candlesticks. If you're curious, the calculation for Heiken Ashi is as follows. Heiken Ashi close is the average of open, high, low, and close. Heiken Ashi open is calculated as the midpoint of the previous Heiken Ashi bar's high. The high for a Heiken Ashi bar is determined by taking the highest value of high, close, and open. The low for a Heiken Ashi bar is determined by taking the lowest value of low, close, and open. It's not necessary to memorize the calculation formula for Heiken Ashi. Understanding the exact calculation method is not necessary for becoming more profitable in trading. The main purpose of Heiken Ashi is to help identify trends in the market more effectively. Additionally, it's important to note that Heiken Ashi bars should not be considered a trading system. Using them as a sole indicator to make buy or sell decisions will likely result in poor performance. Like traditional candlestick charts, Heiken Ashi bars simply provide information about the market. When it comes to Heiken Ashi price action patterns, there are fewer variations compared to traditional candlestick patterns. For example, with candlestick bars, there are numerous types of patterns such as doji, gravestone doji, dragonfly doji, pin bars, engulfing candlesticks, and so forth. However, with Heiken Ashi bars, I have simplified them into 3 main types of price action patterns, making it easier to analyze and reducing the noise while trading. The first type of Heiken Ashi pattern is the bullish bar. These bars are characterized by the presence of a wick at the top and the absence of a wick at the bottom. As long as the bar is an upward trend with no wick at the bottom, it is considered a bullish signal. The second pattern is the bearish Heiken Ashi bar. These bars are the opposite of bullish bars. They have a wick at the bottom, but no wick at the top. As long as the bar is a downward trend with no wick at the top, it is considered a bearish signal. The third pattern is the indecision Heiken Ashi bar. To simplify the Heiken Ashi patterns, all bars that have wicks at both the top and bottom are categorized as indecision bars. Regardless of the color of the bar, if there are wicks on both sides, it is considered an indecision Heiken Ashi bar. But why should you use Heiken Ashi bars in trading? Now that you have an understanding of what Heiken Ashi bars are and the 3 different types of Heiken Ashi price action patterns, you may be wondering why they are useful in trading. The answer is simple. They can simplify the process of making trade entry and exit decisions. Now, let's discuss how to enter into a trade using Heiken Ashi bars. It is important to resist the temptation of making a trade solely based on the appearance of a bullish or bearish Heiken Ashi bar. While some traders may advocate for this approach, it is not a reliable strategy for achieving success in trading. In order to have an advantage in the markets, it is essential to establish specific criteria that must be met before entering into a trade. Now, let's get into the real deal: how to actually practice the Heiken Ashi trading method. When it comes to trading stocks, there are 2 main strategies: going long and going short. Going long means buying shares with the expectation that their value will increase, while going short means selling shares that you do not own with the expectation that their value will decrease. Here are some rules for initiating a long trade. Criteria 1. The higher time frame must be in an uptrend. This means that the high time frame must be making higher highs and higher lows. For example, if you're trading the 1-hour chart, the higher time frame would be the 4-hour chart. And if you're trading the 4-hour chart, the higher time frame would be the daily chart. It is generally not recommended to trade on a time frame lower than 1 hour, as the spread and commissions can eat away at your profit margin. Criteria 2. The 10 exponential moving average must be above the 30 exponential moving average. The EMAE is a technical indicator that helps traders identify trends by smoothing out price fluctuations. The 10 EMAE and 30 EMAE are used to determine the momentum of the trend. Criteria 3. Both criteria 1 and 2 must be met on the time frame you are trading on. Once all 3 criteria are in place, look to go long. When the price bounces off either of the exponential moving averages and the first bullish Heiken Ashi is formed at a higher low, place a stop loss below the low of the current swing low. In order to enter a short trade, the criteria is simply the opposite that of a long trade. Criteria number 1 is that the higher time frame, such as the weekly or monthly chart, must be in a downtrend. This can be identified by looking for patterns where the stock's price is forming lower highs and lower lows. Criteria number 2 is that the 10-day exponential moving average EMAE must be below the 30-day EMAE. When the 10-day EMAE is below the 30-day EMAE, it can indicate that the stock is in a bearish trend. Criteria number 3 is that the time frame you're trading on, such as a 5-minute chart, must also meet criteria 1 and 2. Once you have identified that all 3 criteria are met, you can look to enter a short trade by selling shares when the stock's price bounces off either of the exponential moving averages and the first bearish Heiken Ashi candlestick pattern is formed at a lower high. It's important to note that going short can be a high-risk strategy, and beginners should consult with a financial advisor or professional before making any trades. Now, here's how to exit a trade using Heiken Ashi bars. For long trades, you would want to exit the trade when a bearish Heiken Ashi bar is formed, as this can indicate that the trend is reversing. Similarly, for short trades, you would want to exit the trade when a bullish Heiken Ashi bar is formed. It's important to keep in mind that Heiken Ashi bars may not always be 100% accurate, and you may sometimes get faked out of a trade where a bearish Heiken Ashi bar forms, but the next bar becomes bullish. This is normal, and it's important to focus on your overall profitability over a series of trades. It's always good to have a stop loss in place to protect the trade and take profit at certain level. Also, always trade with the risk management plan. As you have now understood the concept of the Heiken Ashi bars, we can move on to the most important part of the video, practical examples. Just one important thing before we move on. If you're enjoying the video so far and want more simplified trading tutorials, please give this video a thumbs up, turn on notifications and subscribe. Your support really means a lot. Now, let's move on to the examples. For this part of the video, I won't be talking in the background. The charts and symbols will speak for themselves. One of the benefits of using Heiken Ashi bars is that they can help traders simplify the process of entering and exiting trades. By smoothing out the price action, Heiken Ashi bars can make it easier to identify patterns and trends that may not be as apparent with traditional candlesticks. It's important to note that Heiken Ashi bars are just one of the many tools that traders can use to analyze the market. It's always good to use multiple tools and indicators to get the better understanding of the market and to make informed decisions. You stayed through the whole video. Well done, I'm very proud of you. If you learned something new, make sure you like this video, turn on notifications and subscribe. See you next video.